Welcome back to the Babalian Money Show, your go-to place for making sense of the financial world. Today, we're tackling a huge question: stocks, ETFs, or crypto? What's the smartest place for your money as we head into 2025? It's a debate that's all over the internet, so we're going to break it down, cut through the noise, and give you the real deal pros and cons of each. Before we dive in, a quick but important heads up. I am not a financial advisor, and this video is for educational and entertainment purposes only. Investing involves risk, and you should always do your own research or consult with a qualified professional before making any financial decisions. Your financial future is your responsibility, so let's get you equipped with the right knowledge. All right, let's start with the classic: individual stocks. When you buy a stock, you're buying a small piece of a publicly traded company. Think Apple, Amazon, or Tesla. The big appeal here is the potential for massive returns. If you pick the next big thing before anyone else, your investment could skyrocket. Remember the stories of early investors in tech giants? That's the dream. Buying stocks gives you a direct stake in a company's success. You get to be part of their story, receive dividends if they issue them, and have voting rights as a shareholder. It's empowering. However, that high reward potential comes with high risk. Individual stocks can be incredibly volatile. A single bad earnings report, a management scandal, or a new competitor can send a stock's price plummeting. Remember the saying, don't put all your eggs in one basket. That is especially true here. To build a solid stock portfolio, you need to diversify across many different companies and industries, which requires a lot of research, time, and frankly, a good amount of capital to do it effectively. You need to read financial statements, understand market trends, and constantly monitor your holdings. It's not a set it and forget it strategy. For those who love the thrill of the hunt and are willing to do the homework, stocks can be incredibly rewarding. But for beginners, it can feel like trying to drink from a fire hose. So, what if you want the growth of the stock market without having to pick individual winners? That's where ETFs, or exchange-traded funds, come in. Imagine a basket containing hundreds or even thousands of different stocks. When you buy a share of an ETF, you're buying a tiny piece of every single stock in that basket. It's instant diversification. The most famous example is an S&P 500 ETF, like SPY or VUI. By buying just one share, you're invested in the 500 largest companies in the United States. If one company has a bad quarter, it's balanced out by the other 499. This massively reduces your risk compared to holding just a few individual stocks. ETFs are also incredibly simple and cost-effective. They trade just like stocks on an exchange, so you can buy and sell them throughout the day, and their management fees are typically very low. This makes them a fantastic starting point for new investors. It's a way to get broad market exposure and let your money grow with the overall economy. The downside? Well, you will never get that explosive 100x return from a single ETF that you might get from a single stock. An ETF's performance is the average of all its holdings. You get the market's ups, but you also get its downs. You're trading the potential for astronomical gains for stability and simplicity. For most people building long-term wealth, that's a trade they are very happy to make. ETFs are the marathon runners of the investing world, steady, reliable, and built for the long haul. Now, let's talk about the wild child of the financial world: cryptocurrency. Bitcoin, Ethereum, and thousands of other digital assets. Crypto operates on a decentralized technology called the blockchain, which is a secure and transparent public ledger. The appeal is massive. We've all heard the stories of people becoming millionaires overnight. The technology promises to revolutionize everything from finance to art, and if you get in on the right project early, the returns can be life-changing. It represents a completely new asset class, untied to traditional government and banking systems. For some, it's the future of money itself. But let's be crystal clear. Crypto is the definition of high risk, high reward. The market is insanely volatile. It's not uncommon for a coin to jump 50% in a day and then fall 60% the next. The space is also largely unregulated, which makes it a playground for scams and hacks. There's no safety net. If you lose your crypto or get scammed, your money is likely gone forever. Predicting which projects will succeed and which will fail is incredibly difficult, even for experts. It's driven as much by hype and social media trends as it is by fundamental technology. Investing in crypto requires a strong stomach for risk and a willingness to potentially lose your entire investment. That's why the common advice is to only invest what you're willing to lose. Think of it as speculative. It might have a place in a well-diversified portfolio, but it probably shouldn't be the foundation of your retirement plan. The technology is fascinating and potentially world-changing, but as an investment, it's still the Wild West. So, what's the verdict for 2025? Stocks, ETFs, or crypto? The boring but correct answer is, it depends entirely on you. It depends on your financial goals, your timeline, and most importantly, your risk tolerance. Let's create a framework. If you're a long-term investor, perhaps saving for retirement in 20 or 30 years, and you want a simple, proven strategy for building wealth, ETFs are likely your best friend. A core portfolio built around broad market ETFs like an S&P 500 fund and an international stock fund is a fantastic, low-cost foundation. It's the get-rich-slowly approach, but it's one of the most reliable paths out there. If you have a higher risk tolerance, enjoy research, and want to be more hands-on with your investments, you might add individual stocks to that core ETF portfolio. Maybe you allocate 80% of your investment funds to ETFs for stability, and use the other 20% to pick a handful of companies you truly believe in for the long term. This hybrid approach gives you a solid base while still allowing for the potential of higher returns from your stock picks. It's a way to scratch that stock-picking itch without betting the whole farm. And what about crypto? Given its extreme volatility, it should be treated as the most speculative part of your portfolio. For most people, this means allocating a very small percentage, say 1% to 5% of your total investable assets. This is your moonshot money. If it goes to zero, your financial plan isn't ruined. If it takes off, it's a fantastic bonus. Don't let the fear of missing out or FOMO trick you into putting your rent money into a meme coin. That is not investing. That is gambling. So the best strategy for 2025 isn't about choosing just one. It's about building a balanced portfolio that reflects who you are as an investor. For the vast majority, the winning combination will likely be a portfolio dominated by low-cost ETFs, perhaps spiced up with a few individual stocks you've carefully researched, and a tiny, speculative slice allocated to crypto if you can stomach the risk. The key is to not get caught up in the hype. Don't chase last year's winners. Instead, build a diversified, long-term plan that you can stick with through market ups and downs. That is the real secret to winning at investing, not just in 2025, but for decades to come. What's your strategy? Are you team ETF, team stock, team crypto, or a mix of all three? Let me know in the comments below. I love reading your perspectives. And if you found this breakdown helpful and want more straightforward financial content to help you on your wealth-building journey, do me a huge favor and hit that subscribe button and ring the notification bell. It's the best way to support the channel and make sure you don't miss our future videos. Thanks for watching the Babalian Money Show, and I'll see you in the next one.